Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known by many of you as Mr. Valuation. This is going to be part 2 of what turned out to be a series of videos on value traps. In the first video, I was really asked, how do you identify a value trap? What's the difference between a value trap and a value stock was really the question. So I did the first video and I really just contrasted using historical data what really turns out to be a value trap versus what turns out to be a value stock. And again, I primarily looked at historical data in doing that because the idea was just simply to give a perspective of the difference. You know, it's widely accepted that one of the first rules of solving a problem is the first thing you got to do is identify the problem. So first way of avoiding a value trap is to know what a value trap is in the first place. So that's what I did on that first video. Now, I did get several comments that I do want to address in this video as a result of that video. And I'm going to excuse me for turning away from the camera, but let me read some of these comments for you. The first one was from Whisper. And he said, "Thanks, Chuck, for answering this great question." I appreciate that, Whisper. "The hard part is understanding or realizing when the business fundamentals change for the worst." So to be clear now, to interrupt here for a moment, the big difference between a value trap and a value stock is a stock whose price falls while the fundamentals remain strong, or, as I did in the Marty Whitman quote I used in the last video, there's a mere temporary interruption in an otherwise very strong business. That becomes a value opportunity, not a value trap. A value trap is when you have a permanent impairment of capital where the business is actually changing virtually on a permanent basis, or at least a very long-term basis, for the worse. So the fundamental deterioration versus just simply stock price drop is the basic distinction between a value stock and a value trap. But then Whisper goes on to say, "The problem I see is that future earnings may be overestimated by analysts." And then he says, and I want to clarify this, which unfortunately FastGraphs relies on to illustrate where the earnings might be going. I don't know what the workaround for this is. Well, Whisper, I'll try to clarify that as I go through this video when I get into the part. But I want to make a point about FastGraphs. To say that FastGraphs relies on that is simply unfair. FastGraphs is an authentic research tool. Okay, you have to forecast. You can only invest in the future. You cannot invest in the past. So we start with giving you the consensus of leading analysts that follow the company, what their view of what the company is going to look like in the next, over the next period of time. Now, there's this concept out there that seems to believe that analysts tend to overestimate earnings. I found that in 50 years of doing this to be exactly the opposite. Analysts tend to underestimate earnings going forward. And the reason for that is because analysts get most of their ideas, if you will, or their idea of what the future might be from company guidance. Companies in meetings with analyst meetings, they tend to try to give the analysts their perspective of where they think the business is going. And then the analysts typically, which is human, use that as a basis to go forward. And companies are always better served to underestimate their future potential than to overestimate it and then miss it. Because stocks will gyrate quite strongly on earnings misses and earnings beats over the short run. So companies, at least good companies, and the majority of companies in my experience, tend to underestimate estimates. But that is only a starting point. All that does is help you, make the determination whether or not, the stock is even worth doing some further research on, because ultimately, the best way to identify, and I'll cover this in more detail, a value trap versus a value stock is through comprehensive research and due diligence. FastGraphs is the tool that facilitates the exercise of that process. It helps you. It even has external links that take you to certain research services that you can utilize to learn more about the company. Perhaps most importantly, the company's website, where you can go in and look at the same presentations that I referenced earlier that these analysts use when they go to these analyst meetings to try to determine what their forecasts are going to be. Okay, so FastGraphs isn't relying on analyst estimates. You have to forecast. That's a must. So we simply give you what the leading minds are saying, and then leave it up to you to go beyond that. But that's only and always only the starting point. We're not relying on the tool isn't relying on them. They're simply sharing them with you. And then another one, David Hoekstra, I'm not sure how you pronounce your last name, David, said, Video shows clearly the difference between a value stock and a value trap. Then he, of course, has to add after the fact. Well, yeah, but the whole purpose of that video, I'm going to repeat myself again because I had to do it several times in the comment section, was to show you the difference between a value stock and a value trap. That was the purpose of that. I wasn't showing you how to identify it in advance, which this video is going to be all about. He said there was no hint on how to spot this at the time when you could actually use it to make a good decision. Thus, I have a hard time seeing any value in the video. Well, as I said earlier, the most important step in solving a problem is to first identify the problem. And so the best way to avoid a value trap is to know what a value trap is in the first place. So again, I stand by, the value of the first video that I produced. But the bottom line is, I get the question. And I'm going to even give David and Whisper both, an apology. I don't want to come off like I'm being cynical about their question because it's a legitimate question. Okay, that's what a value trap is, but how do you spot it in advance? And that's a very, very important question. I'm going to attempt to kind of touch the surface of how you can go about a process of identifying a value trap in advance. And I'm going to show you some ways to do that. But before I start, let me go ahead and go into the fast graph tool now. And I want to start by looking at some true value stocks, okay? The point I'm getting at here is that the big distinguishing factor, if you remember, is the fundamentals stay strong, but the stock price falls. So I'm adding weekly closing stock prices now on Johnson & Johnson. And this is when Johnson & Johnson was a value stock back here coming out of the Great Recession. The reason it was a value stock was because the business continued to grow. Now, there's another first step that I like to use if I'm looking for, am I facing a potential value trap? And it'll be a new feature on the new fast graphs, is that I like to go look at sales because everything starts, with the top line. And Johnson & Johnson's sales were continuing to grow when their stock got very inexpensive. So if sales are deteriorating, that would be one of the first places you might want to look at. Gross revenues or sales is going to help you determine because you can't make any money if you aren't selling any product, obviously. Okay, but the other point I want to make is you're rarely going to find a value trap that has histories like this. So let me go through just a couple other, of course, this is AAA rated Johnson & Johnson, extremely high quality company, very modest debt, and, a very consistent earnings growth. The only blemish in their earnings history was during COVID, and it was, only minor. They had a 7% drop in earnings, which gave them the third most profitable year in the company's history. Okay, so, this was hardly a value trap, obviously. But just some other examples. Now, this is one that I did a video on about here, and I did not recognize it as a value trap. The company lost some business. They had some real issues going on at the time, and they went into a tailspin of earnings. And they made an acquisition. They kind of turned their business around, and it turned out to be a non-value trap in the long run, but it was a value trap when this was going on. Now, I use this example because I want to make a point. There are sometimes you simply cannot recognize a value trap in advance. There are things that come out of the blue. COVID would be a good example with companies like in the restaurant business or the cruise line business and several real estate investment trusts. They were just blindsided by a 100-year event. But they were value traps at that point because some of them were very inexpensive prior to the COVID crisis. And then, of course, their businesses literally shut down and their fundamentals collapsed. But they didn't stay permanent value traps in many cases. They actually have begun to recover, many of them, and some of them have already recovered. So there's another issue. There are magnitudes of what a value trap can be and what a value trap is and isn't. But when you look at a company like Cigna, which got very, very inexpensive coming out of the Great Recession, it's been very inexpensive recently. Okay, once again, you're rarely going to see a stock that turns out to be a value trap when you have this kind of historical operating results, and especially when you have this kind of sales and this kind of even surge in sales growth. You're not typically see a value trap. You're going to see a true value stock when you run into a situation like that. Now, Fedex is very interesting because Fedex actually got hurt quite a bit by COVID, especially their, business to business business because, a lot of businesses were shut down when the economy was closed. And, and then they were shipping to individuals' homes and so on. They still were doing that, but that's a much lower margin business. So what it did was it had a great effect, if you will, on FedEx's operating earnings. And there was also some pension costs and so on that affected their diluted earnings or their GAAP earnings. Okay, so we had, a realistic drop in fundamentals here, which did not make this a value stock because it wasn't really at value. If you look at the PE ratios here, if you're basing it on these earnings, it was an extremely overvalued looking stock based on, diluted earnings, et cetera. But the point is their sales actually held up quite well. And they continued to grow. They just had, they obviously had some margin issues. So once again, that's not where you're going to find a value trap in a stock like FedEx. A company like Omnicom Group, which is advertising, which obviously had some issues during COVID, but generally their sales held up and the business did real well. And if I look at it from operating earnings, which I consider to be the best, the best way to look at valuation or the first step to look at valuation, I should say, the stock just really overreacted. The COVID crash was obviously swift. It kind of consolidated for 6 to 9 months or so. And then, of course, we recovered it moved back into alignment with intrinsic value. And I would, again, call it a value stock today as a result. And J2 Global is another one that's very interesting. This is clearly not a value trap, but it could have made you think it was a value trap because we saw a dividend cut. COVID came along. The company had just started paying a dividend. It had been primarily a growth stock historically. That's been really the nature of this company. You can see that it's had, double-digit growth. So the company did, drop and become extremely undervalued there for a point, based on operating earnings. And again, if I look at sales continued to grow and grow very strongly at double-digit rates during this period. Again, not a value trap, okay? So let's take a look at some stocks that, could be value traps, all right, coming up. So now, that's just looking at, again, that's kind of revisiting what I did in part 1, but I also added this issue of one of the first things you want to look at is you want to look at revenues and sales. So the answer to how to identify a value trap is, first of all, if you have the perspective of something like Fast Graphs here, where you can look at the company, this is obviously a stock that has gotten undervalued several times, and it's turned out to be a really great investment when it did, but it's also a very cyclical stock and a very erratic stock. All right. And now all of a sudden the stock got very undervalued based on its earnings growth. And then it, put out a couple of good years of growing. But right now, statistically, this stock looks very good, Dish Network. And let's visit what I'm suggesting. I have a blended PE of under 12, which, to me, a 15 PE, which is what the orange line on this graph is, a general view of fair value for most companies, not all, but the majority of companies. That gives them an earnings yield of 8.4%. I like at least 6.5% to 7% if I'm going to consider a company even reasonably valued. This gives me a good, 8.4%. And I even have a nice margin of safety based on what this year's earnings are estimated to be. And this is an analyst estimate, and this is a company that, reports on a calendar fiscal year. Okay, but then I just look at this graph and I see what analysts are forecasting going forward. So let's start by looking at that here. I am now being alerted by Fast Graphs that analysts do not expect this company to have any growth. They expect to have negative earnings of 22% in 2022, 12% in 2023, and 10% in 2024. Now, interestingly enough, they have been actually increasing their earnings estimates, okay, over the, going back 6 months ago, 3 months ago, and then from the previous estimate. But nevertheless, they are still forecasting dropping earnings. So this gives me a clue if I'm looking at this stock by the statistics, a very low valuation, very high earnings yield, no dividend. Okay, this would say, hey, this looks like a cheap stock on paper, okay, or by statistically speaking. But then when I go in here and look at these forecasts that the analysts are saying, the long-term forecast is for a very strong negative growth going forward. Now, I always like to corroborate that because, analysts are fallible. That's true. You should not expect analysts to be perfectly correct. They're not. If I look at the analyst scorecard on Dish Network, okay, I can clearly see that the analysts have missed estimates, quite a few times. As I pointed out earlier, this is a very cyclical stock. But now these analysts are forecasting very poor growth going forward. So I would go and check something like Yahoo, okay? And Yahoo is giving the next 5 years of earnings growth, if you will, a negative 22%. Look, that's, consistent with what I'm seeing here from the FactSet database, the analysts that are, covering the stock on FactSet. But I've only got 2 analysts here, and I'm not sure if Yahoo doesn't tell me how many, but the analysts clearly believe that this stock is not going to do well, okay? Now, what I'm going to also do then is I'm going to start looking at this company from some of these other aspects, as I pointed out. I think the very first place that I like to go to if I'm going to look at a stock to try to determine whether it might be a value trap or a value investment is I'm going to go ahead and I'm going to look at the top line. Okay, I'm going to go in here and I'm going to look at revenues per share, and you can clearly see revenues per share have been generally dropping since 2015 after they rose a little bit in 13 and 14. Okay, so sales are also looking, kind of poor. Next, I'm going to go and I'm going to check things like gross and net profit margin. Now, I'm looking at their margins long-term historically here, but what's really important is what's happening recently, okay? So I'm going to shorten that to the last 5 years. What's interesting is, and I'm going to draw these as line graphs to separate this so you can see it clearly, gross margins are going up, but net margins are going down. So that tells me that there's some issues going on with, aspects of their business. They're getting a higher gross margin, but they're bringing less of it to the bottom line. Return on invested capital, and this might look better as the bar graph here, has been weakening as well. We can also look at things like return on equity. Return on equity has been dropping dramatically. So as I'm looking under the hood into the financials of this business, I'm seeing some, very early warning signs that kind of corroborate what the analysts have been saying about this stock going forward. So the key is, if I'm going to look for value traps, I'm going to look, I'm going to start doing my research and due diligence. Now, by the way, I'm going to also, go into other research services, which I have access to do that, through the FastGraph tool. I can go in and look at places like the Wall Street Journal. I can go and look at places like Zacks and see if I can get any information on, Dish Network and what, the future might be, in addition to just analyst estimates. I can go into the company's website. What struggles are they having? Where are they having their issues? What are they trying to do? But the bottom line is, when I look at a stock like Dish Network, when I actually look at it from the standpoint of, what its historical operating results are, this has not been a stellar company. This is not a company that's had great historical performance in the first right. So, it's got an iffy kind of business model, anyway. And so when I look at it from a standpoint of adjusted operating earnings, and for those of you who are always challenging this, when I look at it from the standpoint of GAAP or diluted earnings, I see a very cyclical stock. And then when I look at it from the standpoint of what the forecasts are, I see negative growth going forward here. This tells me I've got a potential value trap here, and I would be very, very cautious about buying the stock. So the bottom line is, the answer to how do you identify a value trap in advance is that you begin looking for things that would indicate that you're going to have a long-term deterioration in fundamentals, like you did with Pitney Bowes. Keep in mind, now let's talk about the Pitney Bowes story. Pitney Bowes, their primary business, and I used to use them in my own businesses, were postage meters and postage machines. That's what they were, best known for. And, they had huge ones for large corporations that were sending out, massive amounts of mail to even smaller business like yours truly, where we were still sending out a lot of mail, but we used postage meters to weigh the envelopes, measure the amount of postage we had to add so that we were efficient with our postage uses. And then along came this thing called email. Okay, and all of a sudden, Pitney Bowes' business changed dramatically. That's similar to what's happening with Dish and what's going on with, the way people are getting their viewing habits now in terms of, whether they're getting it from the cable TV or a satellite like Dish Network. They're also using different services where you're getting live streaming and internet and so on and so forth. So their business is in a significant disruption. So another way, people have asked me about the energy stocks. Right now there's an assault on energy stocks. That's very, very clear. So you could look at names, even the best of the breed. If you look at, what was not too very long ago, a AAA rated, one of the few AAA rated stocks, Exxon, you see that their business, has been deteriorating quite a bit. Now they're still maintaining their dividend. The company's doing a lot of things to kind of support their business, but now even their operating cash flows are starting to get where they're barely covering the dividend. If I go ahead and look at sales on this, then you're also seeing that their sales are dropping. So, are the oil stocks, which one of the questions I was asked, a value trap? I'd say there's a very high probability that they are. And the only way you're going to know that is to go in and do research and due diligence. Look at what's happening, with the greening of America, the electric vehicles, solar, wind. How much is that replacing the fossil fuels that a company like Exxon, relies upon? But you're seeing the deterioration in the business fundamentals consistent with the drop in the stock price. That's the key that I want to get at. Here we're looking at sales. Sales have been falling. If I look at free cash flow, which is also important, their free cash flow has not been covering their dividend for quite a long period of time. So you're starting to see what would be quintessentially the definition of a value trap there. Again, great business. It was financially very, very strong, still AA rated, but it's really facing a lot of headwinds right now and some disruptive technology that's changing the scope and the face of their business going forward. Can they turn it around? Maybe. But, this is more of a speculation. I don't know that I'd truly call this a value trap, although I think it has been one for the last 5, 6, or 7 years. I think what it is, the idea is, you're not buying this and buying a cheap stock. You're still buying a stock that actually is pretty expensive relative to what it's actually producing from a standpoint of operating results. So how do you identify a value trap? You look at the quality of the business, the consistency of its operating results. You start with looking at sales because, everything's, ultimately comes to the bottom from the top. The top line is very, very important. But then you need to look at things like their profit margins. Look at things like their quick ratios. Look at the fundamental strengths of the business. A focus on the balance sheet would be hard because, it comes down to conducting research and due diligence. You can get clues that would indicate you might see a value trap, but you also get clues to say you probably aren't seeing a value trap. When fundamentals are extremely strong, the odds are that you're not, in a value trap. When you've got a business that consistently grows their earnings every year and the stock price drops dramatically, odds are that's not a value trap. In fact, clearly this wasn't a value trap. This was a value opportunity, Primerica during COVID. And that's true of the Johnson & Johnson I showed you and the others. So you have to do your homework, and I want to end this video by saying this. There is no perfect answer. Perhaps the best you can expect if you actually truly run into a value trap is to mitigate your losses. As I said in the written portion that I, introduced this video with, as the old adage that says your first loss is your best loss. If you can start to recognize some really cracks in the company's business model, then that's a good time for you to be saying, hey, this might be a potential value trap. But if you see a business that's still generating strong sales, especially one that's still growing their earnings and their cash flows and raising their dividends, odds are you don't have a value trap, you have a true value investment. At some level here, common sense, along with some good old, work, good old effort, putting in some research and due diligence to determine, because you should be doing that with all your stocks. The main message here, I think, is don't just make your decisions based on stock price, because stock prices are often pathological liars, as I said many times. But sometimes they're true indicators of what's going on, i.e., That's what a value trap is. Hope you enjoyed this video. Hope it gave you some greater insight into what a value trap is. Hope it gives you some insights in how to do, some good work to avoid a value trap. And as always, I appreciate it. If you enjoyed this video, give me a like, ring the bell, subscribe to the channel if you haven't already. Help us grow this channel so we can help more investors like yourselves in the future. Thanks for watching.